Some discussions may touch on legal and tax topics, but nothing contained in these episodes should be considered tax or legal advice. David and I are not accountants nor licensed attorneys. Please consult with your tax and legal professionals for advice on your own unique situations.
Hey guys, welcome to the latest episode of the Did It Close podcast. Today we're joined by Wes Easley and as always, our co-host David Dirk Schneider. So we'll jump right into it. So Wes, I know you, I know you, and I know David, but I know you guys haven't met before. So I think it'll be kind of fun giving a little background about each other and kind of David going over your background too on the call a little bit. So kind of just take it from there. So
yeah, you want Wes go first? Or you want me to go first?
We'll let you go first, David, since right. you're running.
So I've been in the commercial real estate business now, or apartment business, for about 22 years. About 20 of that, or 19 of that in the apartment brokerage side, came from the management side. Then before that, even I was in the Marine Corps. So Bryan and I got kind of a lot of similarities when it comes to that kind of stuff in the background, are unique to this industry. Man, love what I do. I joined Colliers, I guess, December. And prior to that, I was a partner at a company called Capstone, which is a privately owned apartment brokerage company. But man, I love this business and own some apartments as well. And couldn't imagine doing anything else.
And you're based where, Dirk?
Sorry, I'm in Oklahoma. Yeah. Oklahoma. So we cover Oklahoma, Arkansas, some of Kansas, sometimes do some stuff in Texas. But I mean, I'd say 95% of our business is Oklahoma and a little bit of Arkansas.
I'm hearing really good things about Oklahoma City. A lot of activity there right now.
Yeah, it's people that can't get yield in a lot of the bigger markets come here, and I always say it's the 401k of your portfolio. You're not going to have huge gains, year over year, but it's for 31 years we've had positive rent growth, just year after year after year after year, and so it's just slow, steady, and it's a good market. And slow right now, just interest rate wise, it's slower than I guess normal.
But there's significant municipal and state investment in the downtown area. Is that right?
Yeah, we've got a really great kind of pro-business local government that has, in the last 10, 15 years has completely transformed Oklahoma City. It's what brought us it was originally the Hornets and then the Thunder. And so, it's changed our city. It's cool to see because, like I said, I've been here all my life. It's really cool to see what it was and where it is now. In some of the areas, like we've this area called Bricktown, this canal, and it's a thriving kind of entertainment district. And I look back as a kid and I was like, man, that used to be an old abandoned warehouse district. And it just looks so different, but it's really cool. I was just
in Columbus the last 2 days, and their Germantown area is so awesome. Like it's like all brick roads, and they were old brick factories back in the day, and they transformed. It was amazing, but kind of similar to what you were talking about there.
I think Columbus was certainly a forebear 25, pushing 30 years ago now, where that whole Germantown Short North district saw a significant reinvestment by major corporation nationwide being one of the major backers, and now the city and the state carried that. And of course now Columbus, for argument's sake, is a legacy market. When you think about Midwest and Rust Belt real estate, and I think. Clearly, as Dirk's saying, Oklahoma City is a emerging market. And how far into Arkansas are you covering? What markets are you guys covering there?
Yeah, no. So all the way through. We've done stuff in Little Rock, but most of it's Northwest Arkansas. That's really where it's popular. The Fayetteville, Bentonville area. It's Walmart's based there, and so that area is just exploding. And it's just a beautiful area too. If you've ever been there. I like to ride motorcycles, and they have just some wonderful, beautiful roads and trails. And but that area it's gotten a lot of interest lately.
I would probably want to catch up with you post podcast and talk about an opportunity to get a tour of some of those markets. I'm linked in with the mayor of Bentonville. I'm as Bryan knows, I'm working on an emerging investment vehicle for markets like that. We'll talk about that, I'm sure, by the end of today's podcast. But Bentonville, Fayetteville are, I think, ground zero for the future of a lot of new urbanism in second and third tier markets. again, it's a great example of corporate benefactors like the Walmarts of the world and the Walton family as a private entity. And then, the state of Arkansas, really stepping up to the plate in conjunction with their municipalities to be, pro investment. And those are some things that, I think some of the legacy cities here in the Northeast could stand to take a page out of their book. So I definitely would like to visit. I've got several motorcycles, so we could even do it on two wheels. So
it'd be fun.
Fun hook.
Yeah, let me know. I'd love to show you around. But yeah, I mean, everything you just said, I agree. I mean, they're both. We get a lot of people that come in and say specifically, like, they're like, we've heard those are very red areas, and they love it, especially from the Northeast. Just 'cause, it's very pro landlord, pro business. It's a great area. So,
do you guys have like a little sidecar I can sit in, since I don't road motorcycles? I'll put some goggles and a scarf on, man. It'll look great.
I have a scooter. I have a scooter you can borrow.
Perfect. I'm all in. I'm good.
Great.
But hey, Wes, why don't you give us a little background about yourself? And it sounds like I think we could talk a little bit because we all see a different markets. I think a lot of let's actually come back to that conversation, talking about like some of the activities that we're seeing in different markets that are incurring economic growth. I think is kind of an interesting thing. But give us a little background about yourself, because I know you've done a number of different things over your career.
Sure. Well, I think like many of our listeners today, and many of the people I've have found and met throughout my 27 years in commercial real estate now, it's not an industry that you find, it's an industry that finds you. Would probably be something we can all relate to. I was going through the state system, getting my degree in communications, minor in accounting, and I was actually interning and interviewing with a major corporation that had built Bradley fighting vehicles. So for you Marines out there, we were the number one, if not the only producer of Bradleys in the entire world. And traveling between South Carolina and York, Pennsylvania, working with them, and thought I was going to go. They offered me a job, and then I surprisingly got a call from a large shopping center REIT that had been headquartered in my hometown, a little closer to Western PA, and offered me a leasing agent role. And I started leasing retail space, from Jacksonville, North Carolina, all the way up to central New Jersey. We had probably 11, 12 million square feet of retail, and got my license, cut my teeth, traveling all over the place, put 60-some thousand miles on a car, due to the ups and downs of the real estate industry. And that's probably one of the bigger features of my career history, is I've followed that sine wave of cycles through economic ups and downs and all kinds of accidental or manufactured credit crises, some of them starting in Asia, some of them post-Reagan era, tax law changes, and then, of course, .com, as well as, things that we've seen in more recent, years relative to recessions and what have you, as well as COVID. But have kind of followed that career and that sine wave. But one of the things that happened was, we merged our REIT after a significant stock price inflection. I ended up without a job, was kind of a young 20-something, and moved to Pittsburgh and ended up getting into the executive search business, only focused on commercial real estate. And it was for a very large and prominent search firm. I had a tremendous career over a decade with them, really built a name from coast to coast. And for whatever the reason was, primarily fueled by the fact that at the time, the Japanese debt crisis had blown up the CMBS world down to kind of I guess you might maybe even call a nuclear meltdown, that any commercial real estate was completely flattened by that. And so apartments had really become the flavor of the day, because they weren't not at the time significantly financed by CMBS. They were mostly financed through Freddie and Fannie type or government type funding. And so I became known as probably one of the top 5 recruiters in the United States, recruiting mostly exclusive to apartment owners and managers. And Did that for someone else for 10 years, struck out on my own like many, built a firm of a dozen professionals that became prominent in and of itself. That's kind of the Icebreaker Resources brand that many people know today. Probably 50% of our business was apartment owners, developers, managers, diversified that into the whole world of private equity as that's become kind of a strong impetus in our industry, as many know, for the past 17 to 20 plus years now. And so probably 50% of our book of business are PE firms, institutional investment managers, ultra high net worth family offices, and just becoming a more seasoned, experienced professional, we began transitioning to the world of strategic consulting and planning, which we've launched a full division focused on working with kind of what I would call go-to-market strategies with these investment groups that range everything from, we've raised a lot of money. We've already placed a lot of money, but now we're finding out a few years later that, some of the partners we're working with aren't performing to the standards we thought. We want to go in and help them engineer better management and systems and processes to build better operating companies. Some of the other things are, hey, we want to expand our fundraising on a more structured basis. How do we develop go-to-market from a sales, business development perspective? I've got significant resources and experience in that. And finally, just wanting to stretch my own entrepreneurial wing as an investor, kind of a year into the thesis development and kind of go-to-market planning, knock on wood, everything works well. At some point in the course of this year, we'll be, formally launching in a very public way, our own kind of boutique investment fund, which I'd be the portfolio manager of. And it's focused on the kind of markets that we're talking about today. The Pittsburghs, the Louisvilles, the Cincy's, Knoxville. I think, eventually we'd love to find the way to get to Huntsville and Bentonville and Fayetteville, places like that, because I believe wholly from all my experience with the bigger coastal and even global private discretionary capital investors that this represents the untapped, uncharted opportunity for alpha in the real estate investment space. So that's a drum I'm beating. Maybe not today so much, but we're just on the cusp of that.
So are you? That's exciting. I mean, it really is. I think that kind of the direction you're going, I think, is a great idea. So right now, are you still doing the exec or the recruiting, the real estate recruiting and kind of executive recruiting stuff, or?
Great question, Dirk. So ran my own firm for 17 years on the heels of working for someone else for a decade. So, 25 plus years, in the headhunting space, really have brought that down to, a trickle. Our firm was doing 75 plus searches a year, with a dozen employees. And as of today, we might pick up 2 to 3 critical executive level searches, president, CEO, chief investment officer for a particularly important client. And there's just really 2 or 3 of us at this point. Probably 50% of my time right now is focused on launching the fund, and then maybe 40% of my time is focused on just these strategic engagements with a couple of very significant investors. As a matter of fact, if anybody here follows my LinkedIn presence for the past several years, you'll notice I travel a lot. You'll find, last week I had a picture of myself next to Dodger Stadium. There's all kinds of interesting investment activity going on in the world of where real estate and sports kind of meet in the middle. The kind of ultra high net worth and private equity investors that are backing those urban strategies in bigger markets. I'm running around meeting those groups, talking to them about their actual boots on the ground real estate platforms. But at the same time, recognizing these are the same exact groups that, they're competing in ultra concentrated, highly competitive, very overpriced, if not significantly mispriced markets such as New York, Philadelphia, Charlotte, LA. And when you comparatively show them the opportunity to get into, an entire city block in Oklahoma City or Bentonville or Knoxville, where you're seeing high single digit to low single digit or a low double digit, year-over-year population growth, and at the same time, what I would call at least market correct pricing. You can show them a vehicle in a relatively highly concentrated way to deploy their capital into a meaningful investment, that they're not going to see that on both the front end pricing. And I believe if the population migration stays at the rate that it is, these same cities we're talking about are going to look somewhat like what we saw happen in Nashville over the past 15 years, or Austin, 20 on the 20-year run out. So I think that's part of my messaging. That's part of the drum I'm beating, is getting to these same investors and say, look, we're not asking you for you to derail your coastal gateway investment strategy. All we're saying is, like any good investor, you need to do portfolio balancing. And a good way to portfolio balance is to look at these markets that range, as I said, from Pittsburgh at the start of the Ohio River Valley all the way down to where it connects with the Mississippi. And if you can kind of draw a horizontal line, a few hundred miles east or west of that Mississippi Valley, you pick up some pretty phenomenal markets along the way.
Yeah, it's interesting. Right now with kind of the shift with interest rates going up and cap rates are kind of in flux. I mean, are you actively buying deals in those markets, or just kind of waiting? And the reason why I think, Bryan coaches commercial real estate brokers, and I do the same thing. It's actually how we met. And I coach a guy in New York, and it's interesting because, they always have had lower cap rates, and just the returns I thought, man, are horrible. But right now, looking at his pipeline, their cap rates are pretty similar to ours. Now, I never really thought about the net migration part, because they're losing people. And so even though maybe you can get a cap rate today, what's that going to be, 5 years from now when you try to sell it? But are you seeing, right now, are you seeing investors that are like, I need to chase that yield, or are they able to get that yield right now because the market's a little slower?
I think that it's one of the reasons I feel really good about what I'm about to launch. And it goes back to my personal story as an executive recruiter for 25 years. You're pitching a narrative, you're pitching a story. If you're taking a highly successful producer, as a broker, an acquisitions person, or a finance person who's being paid presumably pretty well, and then asking them to pick up roots and jump to another organization, kind of out of the blue in a 90 to 120 day period of time, that takes significant trust building and a significant backstory of foundational data. And I'm not saying this to be offensive to the brokerage community in any way, shape, or form, but capital by its nature tends to take the path of least resistance when you talk about the deal side of things. So, brokers tend to, hey, let's swim in the lane of that path of least resistance. And if capital is flowing heavily to Charlotte and Charleston and Savannah, there's a big broker train that kind of follows that pathway. What I'm doing relative to my fund thesis is saying, if you just added a little bit of the narrative of these markets, that's both the city and state, both from a funding as well as a tax incentive basis. Tennessee is a great example of a state with no state income tax, or a lot of these, Ohio, just right across the border, which I would call kind of a purple state. If you look at what their governor has allocated for real estate development incentives at the state level, it's $300 million plus to Pennsylvania's $100 million allocation as far as government subsidy to incentivize development projects, and that's just incubator money. I'm not saying that's something significant, but it's incubator money to incentivize out of state development. So you look at some of the basic narrative at the state and municipal level, and then you add in the additional research around the population trends. You look at the amount of Californians that went to Texas, the amount of Californians in Texas that are realizing, okay, Texas isn't for us, and how they're migrating into these a little bit more neutral territory on this kind of eastern spine of the western spine of the Appalachian chain. The people they call the halfbackers, the Northeasterners that think they're going to love Florida, and they realize it's just a little too hot under the collar in the humidity department. So they come halfway back to the Northeast.
I like that one as well.
and they find themselves in North Carolina or West Virginia or any of those markets, and finding kind of a happy medium. So, I think when you add the narrative of these markets, in addition to the cap rate story, which you're right, I have several clients that are looking at deals in Cleveland and Columbus right now, and they're realizing that, and these are out of state, these are coastal investment groups from
Sure.
LA and New York. They're finding that the cap rates are really not that significantly different in those. They haven't, that's the biggest issue in our industry right now is that we have not seen that significant inflection in pricing to basic fundamentals. But if you add the narrative of the underlying demographics, I think they tell a bigger story, that if you put your marker down here and then you project it out 5 to 7 years and base it on, the economy of where that, demographic economics are going at a consumer level, it's still undeniable we have a significant housing crisis and a shortage of supply across the board. And that's, ranging from the affordable all the way up to the market rate and luxury space. Clearly, more so than anything, this kind of 80 to 110%, or even 60 to maybe 90% AMI spectrum is the most underserved. These markets have a pretty significant disparity. I don't know what the numbers are in Oklahoma City, but it wouldn't be incomprehensible to think that some of these markets in Kentucky, Tennessee, Arkansas, you might have average median household income, in the high 50s to mid $60,000 a year, and there's just no ability to be able to afford a down payment on a purchase, and certainly the housing stock that's been delivered has been either pushed to the extreme ends of below 30% AMI as a fully subsidized affordable, or it's been delivered at kind of the new urbanist tech Californian moving there, tech-driven Californian that's making $150,000 a year, per household, and there's just not enough housing stock in that center space of workforce or essential need, whatever you want to call it. So I think this podcast today, if it can serve to do anything, is bring attention to the fact that there's phenomenal opportunities in the markets we're all, the four of us, or the three of us are all sitting in. So that's kind of where
it's interesting you say that, because I literally just last night I finished this, hadn't even published it, but it was I wrote a blog about the affordability crisis and the lack of housing and all that, and then here you are today talking about it. I just thought that, it's pretty ironic, but I like everything you said, especially given the markets that we're in, and that's the story we preach every day around here, and trying to get people to understand that. So I took a lot of nuggets you said, and I'm going to use some of those because I think you said them a little better than I sometimes do.
I was just thinking, I was like, we splice this up afterwards for some little like teaser clips, and I'm like, there's probably like 30 that we could just grab right there and for some different things.
I think that's one of to tie this back to how the whole conversation originated. How long you've been in the industry, what's your story? It's one of the reasons why I've stayed in it as long as I have, even though I've kind of been a peripheral participant. I had, like all of us, I have my own little side mom and pop real estate investments with my wife of 26 years. And that's been a nice little thing, but that's been more of a hobby. But, I've largely been a consultant. I've largely been fee driven. I've been involved with some pretty tremendous name players over the years, which I consider myself very fortunate to have that experience. But, in taking that massive leap to become, someone that's out there asking for tens of millions of dollars as a principal, is a significant kind of, gut check of reality. And, I'm getting that feedback firsthand from the investment community on what their appetite is for these markets. And it's not radically different than what you guys are responding to here today. But the one thing I like about the real estate industry, why I've stayed in it, is that it's still one of those industries where it takes true collaboration. If I'm a great communicator and I'm a good storyteller, which that's probably my greatest strength, I believe my part of this formula is to get to these investors, whether they're in Munich, Tel Aviv, Beverly Hills, New York City, wherever, and tell the story. Then I've got to work with guys like you to help be part of that connectivity to get that capital to the asset level. And we're structured as an LP fund manager, so we need to meet those local GPs. And these are the guys that, they're busy 99% of their day working on the projects that they're actually investing or developing in. And when they're not doing that, they're managing them. They don't have the time to travel to the big conferences like we do. They don't have the budget in a lot of cases to spend, $50,000, $100,000 a year hitting the investment conference circuit. So it really takes a community of everybody in that chain to make this work if we're going to bring the investment to these interior markets that are lesser known.
So is your fund going to be more, because you just said it right there, going to be kind of more the LP providing equity for new development? And is it just multifamily, or is it a broad spectrum? I mean, can you give me an example of that, of what your goal or plan is?
Sure. And we have a very detailed thesis, and we're going to be going live with, a web presentation and a full-blown investor deck that helps everybody understand, the component pieces of this. But, one of the arguments that, you're going to get with, any, investment or investor right now is, the whole mispricing on construction costs. It's significantly more, attractive, even with the current cap rate and pricing, to buy than to build. Unfortunately, when you're trying to answer a workforce housing situation in some of these somewhat less developed markets, there's just no available housing product, period, of end of story. So if you can find the appropriate investment partner that's got the initiative and the capital tolerance to subsidize privately that construction cost gap, our fund is trying to do that. And I think we saw recently, just so I'm sure you guys tracked it, it was posted on LinkedIn, there was a new construction, I believe 55 plus community. There might have been an affordability factor. It's in Columbus, Ohio. CVS Caremark, a corporate balance sheet investor, ponied up a $10 million check on that deal. So my fund is probably 2/3, maybe as even balanced out as great as 50% corporate balance sheet investors that are looking to make impact investments, that are willing to lean into the development game, even at a somewhat overpriced market, to put well-needed housing in these markets. And then 50% private discretionary capital that's obviously seeking a higher return and a little bit more of a traditional real estate, pro forma when they look at a deal. That's not to say we won't do an acquisitions type investment on a cash flow producing or a mild value add package. It's just that those are fewer and far between, and they're usually bid up, even in these somewhat more, thanks to guys like Bryan doing his job really well, they're usually bid up. But we would certainly look at an acquisitions deal, but it's probably something that's going to be off market. The one thing that I do think that is a critical piece, though, that I think a lot of multifamily investors, whether you're a buyer or a builder, have grossly overlooked, is doing kind of a site location analysis or gravity, to use the technical term, a gravity modeling of, what is the supporting walkability factor to essential need retail. So, in a lot of these cities like Pittsburgh, which is kind of a ground zero market, I'm sure there's elements of this in Oklahoma City and everything that exists in between. There's literally decimated retail properties that were built probably from the 60s all the way through even the early to mid 80s that are sitting there boarded up, completely abandoned in some cases, or it's just really, really strong pad sites that could be developed with some degree of walkability and adjacency to the multifamily community in order to enhance the overall value of the property, the residential property. And so, one of my big gripes is that you see these somewhat, islands, phenomenal Taj Mahal multifamily project, and the only way you're going to get to a grocery store, a drugstore, a shoe repair, a seamstress, a dry cleaner, whatever, is you got to get in a car. And I think that, if you're looking at some of this resident base, as well as the people that are moving to this resident base, ownership of vehicle is not necessarily something that they have. Some of the people moving from San Jose, California, or Manhattan that might be moving into these markets never owned a car. And some of the people that might rest in more of that somewhat more precious, vulnerable AMI situation, where they're living at 60, 70, maybe as much as 80% AMI, they just can't afford a car plus rent, plus groceries and cost of living. So I think to create, easy bus routes, walkability to retail is extremely critical. And so our fund is trying to invest in the retail adjacent to the multifamily, because we see the two as being a very connective story.
Well, have you read any different than what's, because you said that they have pad sites there now, and because we've all seen that. I agree with you 100%. There's retail is kind of going away in some areas, and it's not that walkable. How do you do something different to make it walkable? Because one would think the reason why that land's vacant or the pad site's vacant or that retail building's no longer being used for retail, it's got some sort of a office use or what do they call? I don't know what they call it. Like, when you turn them into like an aquarium and people go visit it, instead of traditional retail. How do you go in and make retail and make it work if others couldn't?
Well, there's a couple things at stake. I think that the retail world has dramatically changed over the past 48 to 60 months. I've met with a couple of officers from regional Federal Reserve offices in the Midwest. And if you look at their, spreads on valuations and debt repayment confidence, as well as just overall underlying occupancies and fundamentals, retail, which was 4 or 5 years ago considered a dirty word, is now the darling class, even surpassing what we're seeing, a depression or in the industrial space. And of course, multifamily is kind of in this precipice of where's it going to go based on the short term debt scenario that has to kind of play its course over the remainder of the next 12 months. So retail with long term leases, with overall corporate, corporate earnings have been, for the most part, very, very strong in the retail sector. National retailers, groups like Aldi, really want into these markets. And so I think that, like everything, the Midwest, some parts of the Deep South are kind of the last to know and last to get the happening news, so to speak, or the trends. So I just don't think the good gospel of where retail is at has not necessarily reached these markets quite with the fervor that you're seeing in the coastal markets. But if I'm a super regional or national grocer, if I'm a super regional or national drugstore chain, if I'm Aldi, if maybe even a global player with a sub brand, it's part and parcel for my team's efforts to get out there and attract them to say, can you guys do a corporate investment to help spur the growth of this retail site and incubate it at kind of a property improvement level, and then we can find a local tenant. But ultimately, I think that the biggest issue has been that I've done a lot of work in Knoxville recently, just meeting with the local officials, meeting with some of the local brokerage community, as well as just getting a good strong lay of the land. And the one thing that the local city leadership there is saying is, look, we've got a robust and thriving demographic situation with the university growing and some corporate growth downtown. But the answer to a lot of the issues when it comes to development of the properties is we just don't have enough developers locally to fill the need. We need to reach outside the local, kind of pot and attract some bigger super regional or national development groups to come in here and help spur this redevelopment effort across all asset classes. So in some cases, markets again like Bentonville or somewhere like that, there's just not a big sophisticated group outside of maybe the 4 or 5 or 6 players that have been prominent for years. But to get to the level of maybe where Pittsburgh or Cincinnati, not even referring to the Charlottes or the DCs of the world, you need to have a significant competitive set of diversified developers and owner operators to bring some of these and take the risk. I mean, that's what this industry has been all about. It's, somebody's got to take the risk and, with proper underwriting, take an educated guess that one of these, investments are going to work. And so I think the retail space is showing significant wins in this, wind in the sails. But it's part and parcel to a successful residential development, in my opinion.
Wes, why do you think that like some cities, it almost seems like some cities are enacting some legislation or policies, right, to address the affordable crisis? We talked and Dirk talked about writing a blog on it, but that are almost like pushing developers out. Right. So, when you mandate certain things that have to be included in developments, such as affordable components, right, it almost pushes them out. And then we have a supply demand imbalance because we're not building. We have a supply constrained market, which is just causing pricing to go up. So it's almost like the exact policies that they're implementing for the problem they're trying to address is exacerbating the problem. I know you've seen a number of different cities, so I was just kind of curious on maybe some of your thoughts around that. Pittsburgh's in the news a lot lately because we're trying to do 10% affordable on any new apartment project in the city, where a lot of developers are just like, I can't make the math work because of construction costs, so I'm going to Ohio, right? Like I'm just leaving the market. So that's just going to exacerbate that problem even more. So I'm just curious on your thoughts on that.
I mean, I need to disclaim that I'm not an affordable housing or subsidized, expert from the technicalities of specific finance nor policy. I've consulted to many of those groups over the years. Probably 30% of my clientele at any one given time were what I would call bona fide capital A affordable housing developers. I can confidently say that because of the way that whole industry is structured, with government participation completely above board, that it's a very, very fee rich and highly incentivized space to be in as a developer of affordable housing. And in order to make that industry float, if not go to the stars or the moon, the city or state or whatever regulating authority at kind of the governmental or quasi boots on the ground municipal level has to be completely integrated and on board to allow those groups to do their apply their trade as the bona fide capital A affordable housing developer. And so certain cities lean into or fully engage in allowing that to happen, usually by way of an administration agenda, or be again state or city. Unfortunately, when that gets hyperheated for whatever motivations, political or otherwise, it squeezes out private investment. And so that's maybe a more articulated or fancy way of seconding exactly what you're saying. It's one of the frustrations I have as a kind of an emerging investment manager trying to answer a housing supply crisis, is that I believe private investment has to be given their kind of unbridled opportunity to come in and take a whack at the housing issue that might be affecting that particular city. And particularly, again, it's in this workforce kind of middle income space that's most affected. The investors seeking highest return have migrated towards the biggest, most sexy market rate, borderline, if not outright luxury projects. I know certain cities have enacted, as you know, these policies on things like 80/20 income distribution in the unit base for a project to get approved. But even with that, it falls short of the need, and so it does result in that imbalance as well as those supply inversions and pricing inversions that you reference. I would ultimately say, Bryan, that the only way to probably attack the problem at its core would be, again, to raise significant investor capital and awareness to basically underwrite, perhaps come on the going in at I won't want to be so aggressive to say it's a loss, but certainly maybe you got to be willing to say these investors are trying to make a true impact in the market, and in some cases I think it might be economically pencil out like a break even in order to put a meaningful project to work, and you got to just look at a larger investment horizon, whereas maybe 6 to 8 years was kind of the rage prior to COVID. That's kind of normalized out to kind of a eight year give or take investment horizon. But, some of these more, quote unquote, risky investments to answer this housing supply issue and combat otherwise ill-advised affordable housing policy in some of these cities, you need to, say, hey, this might be a 12-year investment horizon. And for a lot of, kind of on the come, new money investors, that's probably more than they can tolerate. But there's a lot of, highly deep pocketed old world investment capital out there that does have that tolerance. It's just, you got to go look for it far and wide. It's just not a problem.
I think it's an
regulatory wise.
Yeah, I mean, I think an investor is one thing, right? I mean, not to your point, but I mean, another thing is the development. And I mean, at least I'm of the mindset of, just simple economics is, even if you're building class A luxury, right, you're adding more supply to the market,
100%.
right? Then everything downstream that was already there before. And Austin's a great example of this. It had negative rent. I mean, they built like crazy, and then they had negative rent growth. The supply and demand kind of went back in balance. So the city became, as it was getting unaffordable, by building more, it became more affordable. So it's kind of like, that's my concern, is that we're enacting policies that are pushing developers out. Even if you can find patient capital, the developers aren't willing to put that risk in the game, right? And unless they are, like you said, a capital A affordable developer, but when you're mandating it to the market rate developers as well too, now you're removing a lot of market rate supply from the market, which just causes housing to get more expensive overall. I guess that's my concern. So.
I would agree 100%. I mean, this is literally what I wrote about last night is I mean, it's simple supply and demand, right? I mean, the more supply you can put into a market, the market is going to regulate itself. Now, that said, I do think the government has, there is a need to subsidize affordable housing, but to restrict market rate housing and luxury housing, I think just exacerbates the problem. I mean, you're restricting people from developing units, and you're restricting supply, and that makes everything more expensive. I mean, you look at New York, Los Angeles, San Francisco, Seattle. I mean, all of those markets where they do everything they can to make you provide affordable housing. They have the worst housing problems anywhere ever. And Austin's a great example. Oklahoma City, the reason why we don't have affordable housing problems, we don't have rent restrictions. I mean, I shouldn't say it. We have some rent restriction, but it's a very, conservative policy, and we're not just shoving it down developers' throats. And therefore, there's enough supply. Supply meets demand every year. If there's supply, they build it. If it starts to get overbuilt, they slow down. And markets don't do that. I mean, it blows my mind how those that pass the laws just don't understand that.
I think one of the things that, and I've spent a lot of time, I started traveling to Austin in the early 2000s. I've seen the skyline, go to what it is today, which is remarkable. I've seen the population. I got involved with a couple of actually industrial developers in Nashville probably 15 years ago. And I had a couple of multifamily clients at the time, one of which built, kind of a, no pun intended, a groundbreaking high-rise multifamily mixed use right at the, kind of the entrance to Music Row off of Broadway. And so I saw that market as well. One of the things that when you think about markets that are unlike Austin or even Nashville is that, to some degree, you've got a little wider open topography of those markets that have allowed somewhat unbridled new starts because of just the land is a little more readily available, and at the time was available at a pretty good price. Some of the markets that I'm trying to, at least for, again, strictly me, selfish, but at the end of the day, helpful and hopeful to these markets. Pittsburgh is completely compounded by extreme topography. It's one of the reasons investors have struggled with Pittsburgh, is that it's hard to make sense of the topography. Not that they can't build in the extreme topography. It's they don't understand the demographic ebb and flow, that people refuse to drive through a tunnel or cross a bridge to get to from where they work to where they live. It's a very, very challenging psychological factor of these markets. Cincinnati, you could blink, and it almost feels like you're in the same town, with all due respect to the respective football teams, but they have a similar feel, big river, big mountains, traffic congested bridges, and really poor road infrastructure. And so, I think that problem is slightly less mitigated, in markets like Knoxville or Louisville, and Columbus is dead pancake flat. You just have to be very cognizant of, okay, what are the barriers to entry from a topography perspective? And, if we can just, this is what Dallas has suffered from for years. That's why Dallas and Phoenix have always been poster children for extreme fluctuations in, when the bottom falls out, the amount of foreclosures. It's because you just build a new ring of housing right past the current ring of housing.
Dallas adds around 25,000 units a year to their multifamily inventory.
Right.
It's incredible.
And there's interesting shifts in Dallas right now. And I know maybe we weren't here to talk about Dallas today, but there's a bigger trend afoot. Goldman Sachs is effectively moving their headquarters to Dallas. A couple big government agencies are building significant, federally funded office complexes in North Dallas. Dallas is on an extreme office renaissance, believe it or not. And those people are going to need places to live. And this is not for traditional residents of the DFW triplex. These are people moving from New York. Now, why are they moving from New York? Well, because of beyond significant disproportionate tax situation. State government that has a agenda and a kind of rhyme or reason that's radically different than a lot of the other parts of this country. The California situation is pretty obvious. Insurance in those states, over the top. So there's a trickle down effect. Maybe somebody doesn't want to go to Dallas because there's a whole different lifestyle in Dallas, financially, things like that. That's where a Bentonville or an Oklahoma City becomes extremely attractive. You tried Dallas for a year, but you know what? I want 60 to 70% of the Dallas experience without all the Dallas headache. So you go looking for Bentonville or somewhere like that, Oklahoma City. So, Pittsburgh's a little harder, because we're traditionally considered a Northeast market, even though we've got very Midwest sensibilities here. But there's still a place for everybody. So I think that I think you're right. You need to really be cognizant of how much is, or how likely is it that even the world's greatest, investor package on a specific asset isn't going to get completely impacted by somebody building 200 units next to you 36 months from now.
I want to, because I just I'm checking the time, but there was something I wanted to dive in with you, and it's going to be a complete pivot. So I apologize for the abrupt change.
We've been on that drum for a while now. So
you've seen a lot of through your role, and especially in recruiting and consultative nature. You've seen a lot of different organizations, and without naming names, right? What I'm really curious is what is it? We talk a lot about mindset, Dirk and I do, and building businesses. What makes a good culture? What are some of the elements of different firms that you've seen that where the culture is good, where people thrive, where in other places where it doesn't? Is there any commonalities or anything that you've been able to kind of deduce in your time there? I'd just be kind of curious on your reaction to that. So
I like that question.
That is a great question. And it's probably taken me over 20 years to come to this. And I've now had, the past 5 or 6 to really reflect on it and think back on groups that I've worked with for maybe close to that entire 20 years. Some have good culture, some have bad culture. I've certainly worked with companies that have hideous culture. It's one of the reasons probably a guy like me stayed in business. A company with hideous culture completely revolving doors their team every 18 to 24 months. So that was, beneficial to me, but it was really reputationally very damaging. So, you don't typically want to hang out with those groups too long. And again, the basis of this comment is 100% real estate clients. So this is not me adding conjecture from some left field industry or space. The greatest thing about most real estate companies are that they're hands-on, collaborative, team-driven, and for better, for worse, and I will get to the worst part, is that the culture around real estate has been that you can make beyond the pale of contemporary imagination to most American workers, even at kind of a mid to senior level, but not executive or partner level, you can make a lot of money in real estate investment and development, up and down the food chain. I've got a couple clients that even their secretaries are included in the promote. They've made millionaires of some of their secretaries who've been with the company for 20 years. They get a little, maybe 0.25% of every deal that they do or something, or 1/8%. And if you stay there 20 years, you walk away with a nice, high 6-figure, low 7-figure retirement package. And so they're very proud of that. The problem is that a lot of real estate organizations, particularly as the world has morphed with a millennial workforce, which now represents the significant population of the majority of our companies, that were raised and bred under a bigger global understanding of why people go to work and what you contribute to the world by way of your work. And then, of course, Xenials and who are just entering the marketplace as productive employees. If you come in and you beat, let's go make as much money as we can drum every single day, I think that story and that battle cry falls short when you've got a diversified workplace. It's certainly a nice benefit, and everybody wants to make ends meet and plus have a little left over for fun and for hopefully retirement and things of that nature. But if that's the only drum that your company is beating, and there are certainly a fair share of them in real estate investment and development and all the other ancillary industries that surround our or support real estate, commercial real estate. If that's the only drum your company's beating as a way to reward performance or sometimes obviously curtail or critique poor behaviors of performance, threatening culture, you're not gonna, if you don't, fill in the blanks. Those are culture killers. And I think we need to look maybe one step to the right at our brethren in the hospitality industry. A real estate industry at its core, there's an ownership of a hotel building by some structure or investment vehicle. But what goes on inside those hotel and hospitality buildings is radically different many times than what goes on inside the average commercial real estate facility, certainly even the apartment industry, which is the closest thing to the hotel industry. And these are companies that built their whole reward and employee cultures on making people happy. I went to a couple of big hotel conferences on and off for 10 years. And there was a point where a lot of these hotel executives were crossing over into the apartment industry. And one of the CEOs of it may have been Hyatt, it may have been Hilton, I can't remember, came into a room of multifamily executives and said, "Let me start by saying I'm extremely jealous of each and every one of you, and I envy you." And in the room, probably 1,000 people hushed up, and everybody wanted to know why. They were all on the edge of their seat. And he said, "Because you apartment investors and managers, you have 365 captive days to try to keep your resident happy. You could screw it up 364 times in a row, and as long as you got it right on one of those days, you at least have a shot at re-signing them. Me as a hotel guy, if I don't get it right within the first couple hours, or at the worst, the first night, they are never coming back to my hotel ever again." And that said a lot to me. And I probably heard that 15 years ago. So I think those are the kind of cultural basics that real estate companies really need to embrace. And I will tell you that there are definitely some companies, particularly coming out of these somewhat more humble Midwestern markets, they're doing some extremely innovative things. Why? Because nobody told them they had to do it that way. We've seen some multifamily groups come out of Indianapolis, out of Denver, out of some out of the Carolinas, Greenville, places like that have really infused a work culture of their development and construction, as well as their product, the locations that they select, the marketing, the customer service. The leadership teams come from companies that you wouldn't expect to be traditional real estate backgrounds. It's why? Because there wasn't any other really good person available. So they reached to a company. I know a client that was actually recruited some of their top leadership from a local professional sports team. And they were the administration and staff that was running the pro sports team, and they added a level of customer service and performance metrics, and understood how to mobilize teams in multiple cities, multiple nights of the week. A lot of clients struggle when you're doing out of town construction for the first time. So anybody that's kind of growing up in the shadows of the big New York or Boston or LA or Atlanta development or Dallas, New York real estate type culture, sometimes they all eat and breathe the same education and materials. I think we need to look more innovatively to culture by infusing people from other backgrounds and other types of corporate experiences. And at the end of the day, real estate companies need to say, who's our customer? How do we make them happy? And how do we align everybody in the organization through incentive and reward, as well as, how do we educate the staff that we're all pulling in the same direction of keeping the customer happy? And that customer could be partially an investor. It's going to be an end user, whether you're industrial or you're multifamily or retail. And those are the kind of guiding principles I think really are where a lot of real estate companies need to shift.
That's awesome. Well, as we're running up on time here, and I want to just be cognizant. I know we'll see you on April 3rd at the Multifamily Symposium. So we're excited to have you moderating the panel because you have a lot of experience. But a couple things, tell us a little bit about you. I've already heard motorcycles, but what else do you do for fun? We'll kind of get into a little bit of fun lightning round here.
Sure. I'm in my home office. You'll see on the wall. Maybe there, that's a vintage cycling jersey. I was a nationally ranked bicycle racer, put a couple state medals under my belt in my late teens, early 20s. Right here, believe it or not, is a 100-plus-year-old placard off the side of a hearse. My family was in the mortuary industry for 118 years. So I get a lot of my customer service experience from my father, my grandfather, my uncles, my great grandfather. People sometimes ask me, why were you so good at client consultation and recruiting sometimes in really dire times? It's because I saw my dad really go through great lengths to try to make people laugh and be somewhat more lighthearted in a time of extreme difficulty. That was how I grew up. So I grew up around the customer service. Directly above that, you can't see it. It's a signed and limited edition Leroy Neiman painting of the start of the 24-hour Le Mans. So I love vintage race cars. I've got a couple, I have more than a couple. We'll leave it at that. Antique sports cars, and I probably where most of my disposable income has gone over the years. So if it's got wheels, I love it. I'm a pretty social person. I like to read. I like art collecting. I like antiques. I've got 3 children as we speak today. One is in Milan, one is in London, and one is in Washington, D.C. volunteering for a charity. So my kids are kind of, in their late teens, early 20s, out doing their own thing. My wife and I have been partners in a number of businesses, very real estate centric for over 25 years. So Pittsburgh resident through and through. So a little bit about me personally.
What kind of motorcycle do you have?
I've got a 1993 very numbered limited edition. I think one of 3,500 Heritage Harley. It's a Softail Heritage. It's called the Moo Glide. It's got the cowskin seats, cowskin saddlebags, wide white walls, fish, big fishtails hanging out the back. So it's a pretty cool bike.
I used to have a Heritage Softail. My gosh, what year was it? It was around that. It was a teal and silver tank.
Okay.
But
I know exactly what you're talking about.
Yeah, and I mean, everywhere I would go, it didn't matter if somebody was young or old, everybody loved that bike.
Yeah.
It was.
Now
I've got a 16 Road Glide.
Okay.
So we're touring a little more comfortable.
That's where my wife wants to shift. My wife does ride, but the Softail is nothing. There's no softness in a Softail. So the wife wants a softer sprung, more comfortable touring bike. And then I've got a 1997 Buell Lightning. Again, I'm the second owner. 3,500 miles on it. It's pristine. It's all souped up, extremely fast.
Powerful bike.
Yeah, very fast. Eric Buell from Pittsburgh originally, so kind of a local connection to that. But the Harley engine, pretty much if it's got a V-twin in, I've had Ducatis and all that kind of stuff. I like a bike that makes good noises more than I do outright speed. So that's kind of the bike collection. A couple junkers laying around too, but that's another story. So.
Yeah. Wes, if you were like a lot of listeners maybe like looking to get into the real estate industry, what's some books that you would recommend that you've read? You said you're an avid reader, just some about real estate or kind of about property or anything of that nature, or even about mindset. So.
Yeah. Look, a couple things. We hear it all the time. Real estate is not rocket science. I think most of us can say some of our most financially successful clients, some of them may have barely squeaked their way out of high school. So, and sometimes the ones that have gone on to the umpteenth level of degrees are the ones that are still, pushing paper behind a monitor amongst 300 people in a nameless tower in Manhattan somewhere, barely making ends meet. So I don't think, book smarts necessarily make the professional. It helps, but it's not the recipe for success. So I would say in all my years of training teams, coming in and doing leadership sessions amongst real estate groups, I migrate more toward the books like, Think and Grow Rich. I can't underestimate how powerful of a book that's been, written in the 1920s and still to this day. It's all about the mindset of psychological pushing through, and pushing through difficulties. And this is an extremely difficult industry when it relates to the amount of pressure and kind of naysayers that are going to tell you can't do it. So I think you need to have that psychological companion to help you look within yourself. I also think for any young person that, I've got a son in college right now studying finance at Clemson. We had this conversation yesterday, that he's halfway through. He's getting that classic, should I stick with this major? Half my classmates tell me I'm never going to make it at JP Morgan or some big, Credit Suisse type bank. And I told him, I said, look, I don't necessarily think those are the places for you to begin with. As a result, the book that I read early on was Robert Kiyosaki, Rich Dad, Poor Dad.
Yep.
I mean, you don't need to be
16-year-old reading that right now,
right? You don't need to be going to JP Morgan to make $1 million. You need to find your own path, and you need to look at your strengths, and you don't want to listen to what anybody else told you said or could or couldn't do. So I think that's a very contemporary read, easy to read, and it's been a Bible. And then I met a guy probably 10 years ago. I've had him into my office a few times. Met him through Vistage International, which I'm a member of Vistage up until very recently for almost a decade. His name is Antarctic Mike. It's about a guy who lives in San Diego who actually trained for a marathon on the continent of Antarctica and had never been to Antarctica in his entire life. He found a 28-foot long freezer that was at negative 32 degrees in San Diego and trained and did an entire 26-mile marathon back and forth inside of a 28-foot long freezer in order to train for this marathon in Antarctica. And it just talks about the human will. He was inspired by Sir Ernest Shackleton and, trying to do something that, most men would, probably die in the pursuit of doing. And certainly Shackleton and many of his men, met that same fate. So he was inspired by Shackleton. And then there's also another guy that I guess I'm giving a little free advertising and props to. I met through Vistage. I've paid him to come to Pittsburgh. And it's one thing that I think real estate companies and real estate professionals, particularly at the senior level, fall woefully short of, and that's accountability. You guys, as Marines, don't need any explanation of what accountability is. It's basically doing what you said you would do when you said you would do it. No excuses. The entire military system is built on that, but unfortunately, businesses somehow fail to realize that. And so there's a guy named Mike Scott, and he's written a number of books. And his chief defining topic, he is a military guy. He came through Vietnam as part of a special group of operatives trained to deal with what was unfortunately at the end of the Vietnam War was one of the number one reasons for fatalities in the United States Army was friendly fire fatalities. Subordinates were killing their field lieutenants because they couldn't handle the finger pointing that was going on in the field. And so Mike was part of a special ops group to figure that out. And he came up with this professional business training program about accountability on how to get your people to do what they said they would do without killing you as the manager in the process. And so it's transformed my company. And I'm using it to help transform some of my client companies as well. So hopefully that's a little bit of a quick rundown on what I feel is important.
I need to read that one because I don't want my staff to kill me.
Yeah. What was the name? What was the name of that again?
So the guy's name is Mike Scott.
Mike Scott.
And we can certainly find a link to put it up. But it's
yeah.
all
We'll put that in the show notes as long as it's not a link to the show The Office. It's Scranton.
Yeah, that's right. Yeah, just a convenient. His moniker is Totally Accountable Systems.
Okay. Totally. Well, Wes, this has been awesome. We'd love to have you back because I think there's so much more we could dive into. I mean, I think like a lot of the listeners would probably like to say, like, how did you get a fund off, started? Like, what's that look like? I think there's probably like 6 or 7 more topics that we could probably take an hour plus. So if you're willing, we'd love to have you back. So.
Absolutely. Looking forward to meeting everybody at the Colliers Multifamily Symposium in Pittsburgh on the 3rd. And until then, Dirk, I will take you up on an offer to come visit on your back 40, and we'll go from there.
Yeah, let me know anytime.
Sounds good, guys. Thanks, everybody.